Yeah.
Yes, I have a couple goals for today, and I so appreciate Janet and everybody having me back. I want to make sure that we kind of talk you down from the ledge. So I'm going to start up front with kind of why the market isn't as bad as what everybody's saying. In fact, the numbers are going up, not down, whether it's sales or prices or what have you. I think that's relevant because we need to get buyers back in the game. We've got that brother-in-law effect that I always talk about, which is very much alive and well, that people are waiting for a foreclosure crisis and prices to plunge and for the bottom to fall out of the market as if it were 2008 all over again. And I just don't think that's going to happen. And on top of that, not only do I not think prices are going to tank substantially, but also I think there's a chance we could see even higher interest rates than what we have right now. And so again, I think it behooves us to really embrace that role as the trusted advisor and the local expert to show the facts of what's really going on, because you could end up just paying even more money at even higher rates by waiting. And I think that's something that bears telling, and just getting buyers more focused on the long run price trends and wealth accumulation and all the stuff that home ownership, really matters for, and less focused on the most recent scary headline they just read or the email newsletter that their brother-in-law just sent them telling them that the market's about to fall apart. Because in fact, if you look at the data, quite the opposite is happening. I do want to kind of put on your radar some of the broader macro risks though. And even though I don't see housing being the kind of ground zero for any kind of economic catastrophe, I do think that we're in for an economy that, even if it doesn't tip into a recession officially, will be slower than we've enjoyed up to this point in the recovery. And that means, again, the buyers and sellers really need us. A lot of conflicting reports. They won't have the kind of economic tailwind at their backs the way that they've had. Jobs and things like that won't be as plentiful. And I think inflation will be slower to go away, which is also why, we still have elevated rates into the foreseeable future, at least, through this year. And then I want to talk a little bit about commercial, because I do think the commercial market is a little bit more of a kind of front and center risk for the broader economy. And then I'll just end on why I still don't think, even all of that stuff notwithstanding, why this isn't 2008 all over again. And we shouldn't be expecting a big foreclosure crisis, but also, a big increase in housing inventory from distressed sales or anything like that, meaning that I think inventory is going to be the limiting factor moving forward. And when you look through all of the data, it kind of backs that up, because not only are sales and prices going up, but the market's also getting a lot more competitive, even though rates are still 6.8% or so. But let's talk through a little bit of the good news. And even though rates are up, they were up above 7% there for a while. And we had a bit of a reprieve recently, kind of in the wake of the debt ceiling dust up, and also just with these bank failures and things like that, it drove a little bit of a flight to safety, and we kind of benefited from that. You can see 10 years started to go down back in March when they were around 7% for mortgage rates, and that's translated through to 30-year fixed rate mortgages. But we're still a much higher rate environment than we have been up to this point in the cycle. But again, I think if you look at where the Fed funds rate's at, it's well above the 10-year, and we'll talk about this in a second. But I think that means that we'll probably see the 10-year ultimately rise eventually. And even if that doesn't translate through 1-for-1 into increased mortgage rates, and I do think there's a chance we could see a 7% rate again or even higher, I don't think we should expect rates to be falling anytime in the near future, because again, the Fed said they're still going to raise rates 2 more times coming out of their June meeting. And even if they don't do that, they're still way above where the 10-year is, and that doesn't make sense long term. And again, buyers need to hear that, because I still read articles that say we're going to be down at 5% rates later this year. And I just don't think, through the lens of what the Fed's going to do, that makes much sense. And you can see here that mortgage applications at these higher rates are depressed. So buyer demand continues to suffer from the fact that we're near 7%. The new purchase applications for this year, which I'm showing you in green, and we've got about a half a year's worth of data now, they continue to underperform where the market has been, not just during the pandemic when the numbers were really high, but even the pre-pandemic levels of 2018 and 19. Part of this is affordability, right? At 6.8%, you don't qualify for as much home as you did in the past. And so some buyers have been sidelined just purely because they can't find inventory that they do qualify for. But another part of this, I think, is the brother-in-law effect, keeping qualified buyers still on the sidelines. The labor markets, as I'll show you in a second, are still doing well, but you've got a lot of folks holding off because they think prices are going to go down. There's that like psychological scar tissue from 2008 where they don't want to be the last ones into the market. And I think missing the fact that housing is all about the long term, and the long term appreciation and wealth accumulation is unmarred by the current business cycle. The Fed's going to, raise and lower rates, and the economy is going to go up and down. But over the long term, we still know that housing is the one and only way to build wealth in this country. That's what people should be focused on. If rates go down later and you can refi, great. But in the meantime, you should be accumulating equity and paying down principal and all of that stuff, assuming you can find a house that you like and you can afford. I think this is a number that we can start to move the needle on, even though we're not going to get it all the way back to where it was in 2020, again, because of affordability and higher rates, but it doesn't need to be as depressed as it is right now. If you look at the biggest change in the market this year versus last year and the last couple of years, it's mostly because the top end of the market isn't growing as much anymore. So yes, sales in 23 are down about 30% statewide across the board, but it's mostly because sales at the top end of the market, 2, 3, 5, 10 million and up, are no longer doubling as they were back in 2020 and 2021. So we just had a lot of explosive growth at the high end that's moderated a bit. The bottom end of the market doesn't look that much different than it has the last couple of years. The reason why we're shrinking so much is because the top end has dried up as rates have gone up, and most people have kind of gone out and purchased those more expensive homes up to this point. You see the same kind of story playing itself out locally, right? Like 500,000 and up did extremely well in Tulare County the preceding couple of years. It grew by almost 60%, 750 to a million. A million and up grew by 214%. That means it tripled in 2021 and doubled again on top of that almost in 2022. And those have since started to subside. And again, that drives a lot of this decline, even though everything below 500,000 is also down this year. There's that kind of affordability piece, but there's also just a normalization after having such explosive growth at the top end of the market as well. But if you look at the actual trend line, transactions have been rising in the last 4 or 5 months. Statewide, we fell to a 235,000 unit pace back in November. And although we haven't bounced all the way back to where we were even before the pandemic, and actually, if you look at the year-to-year comparison, May was down 23% from where it was last May, but it's also up to 290,000 units from a bottom of 235. So that's nothing to sneeze at. The market is actually increasing, not decreasing, and that does fly in the face of a lot of these newspaper headlines. Yes, sales are depressed relative to those, pandemic highs, or even where we were for most of the preceding decade, but they are coming back. And I think that's an important story that we can be telling. They were up almost 10% in May. If you look at the weekly data, right, you can see that actually in Tulare County, they're going up as well, right? And this is data that runs right up through last weekend. And you can see that the numbers, again, for sales aren't back to where they were in 2020 or 2021, but they are in fact going up even in the local market. If you look at our weekly data, right, and this is for the state as a whole, we continue to see that upward trajectory, even though it's starting to peter out. We're getting to the end of the home buying season as we got to the end of June, but we did maintain that relatively elevated level, at least from those pits that we hit back in the spring or winter of last year, And even though I brought the local weekly data, and again, this runs right up through last weekend, you're seeing that same kind of trend where sales have gone up, They're starting to peak out as we get to the end of the home buying season, but they are in fact up from those very low levels that we hit at the beginning of the year. Pending sales were also up about 11% last month, and we maintained, or excuse me, in May, and we basically maintained that pace in June. So don't get me in trouble at work because we haven't published the June data yet, but they were only down statewide 1.4%, meaning that we're kind of hovering, and we should see relatively strong sales in both June and July once we finally kind of crunch the numbers on the monthly closeout. Pending sales in Tulare also remained elevated, right? So that means July should also be pretty decent. The numbers, again, are higher than they were. They're not great, and they're still low compared to the last couple of years, but they are moving in the right direction. And again, I think this is important for us to know, just for our own business, right? That you don't want to throw it in cruise control. But I do think we've seen the bottom in terms of transactions. We're back at the end of December. We were only closing or putting 25 homes a week into escrow. That was up actually a little bit more than it was in the rest of the state. So we're kind of punching above our weight in terms of putting folks into escrow, and that should, keep sales relatively strong locally, at least for the next couple of months. You can see, unlike the rest of the state, we actually went up not just 12% for pendings in May, which is why I think the June number will be decent, but also another 2% increase in June, meaning the July number should be pretty solid as well. And they went down just a hair in the rest of the state. And so again, I think this both points to a trend that shows sales going up, and also to a local market that's actually punching above its weight and relatively still more affordable than many other parts. And I think benefiting from, potentially folks moving from other parts of California to the Central Valley. We've seen that go on quite a bit. The other thing you're not seeing in the newspaper is that prices are going up, right? Again, if you do a kind of year-to-year comparison, comparing, and this is a May number. I apologize that it says April. It's actually through May. But prices actually went up another 2% in May. And even though they're down 6.4% on a year-to-year basis, comparing to the same month of last year, they've been going up in the last 4 months. And it looks like they were up again in June, although we haven't officially released that number. And so again, contrary to a story out there that says that the market is about to implode, we see that sales are going back up from the pits that we hit in the winter. We've actually been above 800,000 as a statewide median price now for the last 3 months in a row. And I think we're at the highest level for home prices since rates started going back up in March and April of last year. If you look at it on a per square foot basis, and this kind of gets rid of some of the inflated prices that we had last year because we were selling so many homes at the very top end of the market, you can see the per square foot price is actually a lot closer to those all-time highs than the overall median price, just because of how we calculate that data. So overall shows a market that's getting stronger, not weaker. And I think that should be just, some solace to us as real estate professionals, but also a motivator for buyers who may be sitting on the sidelines thinking these huge discounts are coming down the pike. And again, it's broad-based. It's happening pretty much across the state in terms of prices going up. Central Valley is actually leading that charge. And if you look at Tulare's median price month to month, and this is through June now, you can see that we're getting really close to that all-time high. So again, if you think you're going to save a bunch of money by waiting, that doesn't seem to be borne out by what we're seeing happen in the data. And this is even with the top end of the market having shrunk from tripling locally to now shrinking. And we're still seeing these big numbers in terms of an overall median price. And you can see since hitting the bottom at 333, they've climbed a substantial amount. And I think that's something that buyers should know, especially as rates start to go up, and hopefully, helps give you some confidence that we've seen the worst, at least in terms of transactions for the market. And we don't want to pop the champagne corks and start celebrating, because I think that, 500,000 unit or so pace that we hit back in late 2020 and early 21, it's going to take us a long time, frankly, to get back there, but not because we don't have enough buyers. Even though rates are higher, they're not particularly high by historical standards, right? I'm the son of a guy who used to brag about his, 12.5% mortgage back in the 80s. And there's still plenty of buyers out there relative to the number of homes that we actually have for sale. And I think that's why these price numbers are going up the way that they are, and hopefully why we've seen the bottom for sales. Even if rates do go up a little bit, most of the adjustment, the 300 basis point jump that we've already experienced, that's going to be the bulk of the increase. They might go up to 7.5% even, but that's only a 50 basis point jump. Most of that adjustment is behind us, and we've still got a lot of high income earners doing well economically. But I do think, there are some risks and challenges ahead, not due to housing, but rather just because of how hot the economy has been running up to this point, and all of the kind of unintended consequences of the monetary policy that we've used, giving lots of stimulus out and things like that. And I just want to make sure that you have these on your radar, not because I want to corroborate your brother-in-law's predictions in his email newsletter, but mostly just so that you know how bad the consumers out there are going to be needing us in the weeks and months ahead, and how tight I think the market is going to be, just because we haven't had to grapple with an economy that, even if it isn't in an official recession, I think will be slower than it has been up to this point in the recovery. And there's two primary areas of concern for me for the macro environment. So I'm just going to kind of walk through those two areas and why I think we need to keep a nose to the grindstone approach when it comes to working with those buyers and sellers in the weeks and months ahead. On the good, one hand, the good news is that, even with all of these, really negative headlines about bank failures and layoffs at places like Twitter and Facebook in the Bay Area, unemployment claims are still low. We actually had one of the lowest numbers of new unemployment insurance filings in a long time. Most of the people that want to work in this state have jobs, and incomes actually continue to rise at some of the highest levels we've seen going back, not just the last couple of years, but over the last decade. The challenge, though, is that we're in this weird, unique situation because of the pandemic and how it affected the service sector, the cost of childcare, but also because it forced so many folks into early retirement who were doing well financially. Their homes appreciated a bunch. They were getting close to retirement anyway, and those jobs have been really hard to fill. And actually, for the first time in a very long time, when you look at the labor demand numbers, which is the number of jobs that we either have bodies in or the open jobs that we need to fill still, and you compare that to the number of people that are either working in a job that they can kind of jump ship and take this other job, or are not working but looking for work, are way out of whack, right? We have more demand for labor than we actually have, workers to fill those jobs. And although, that has helped to contribute to some of this really strong wage growth, I think it's also contributed to the consumer price inflation that we've seen up to this point. And I think that's going to be the stickier part to get rid of when it comes to inflation, and why I'm not optimistic that the Fed's going to start cutting rates over the near term, and why we won't probably get back to a 5% mortgage rate this year, because ultimately, even though this has started to erode a little bit, if you measure the gap between labor supply and labor demand, we still have about 3.7 million more jobs than we have workers to fill those positions. That's an improvement from when the shortage was almost 6.1 million workers. But even as inflation has improved substantially because a lot of the supply chain issues that we ran into during the pandemic, where we weren't, getting cars on car lots or getting chips shipped in from China to put in the computers, and all of that stuff has gone away. This labor shortage, I think, is going to keep us from getting that kind of last mile when it comes to inflation, and why the Fed's going to be loath to start cutting rates. It has, again, contributed to some of the best growth in wages that we've seen in over a decade, but unfortunately, businesses are still passing most of those costs on to consumers, meaning that the Fed is going to have to stay pretty aggressive. And even in the most recent data for May and June, right, you can still see almost a 5% increase in average wages. This is ultimately, I think, from a long run standpoint, a good thing, right? Because wages are up a lot from where they were even before the pandemic. The average hourly wage was $28 back in 2020 before the pandemic kicked in. Today, it's about $33, which is almost an 18% increase in wages. We've got a big affordability challenge. We want people out there making more money, certainly, but also kind of highlights the labor shortage component and how all of that kind of dynamic is playing itself out in terms of inflation. And that's why even though the inflation numbers have improved from almost 10% on a year-to-year basis to 4%, that's good, right? We want to see it moving in that direction, and it's doing so on a consistent basis, but it's still double where the Fed wants it to be. And this is, again, why I'm relatively pessimistic that we're going to see a lot of rate cuts from the Federal Reserve, because the last, it's kind of like losing weight, right? Like the first 15 pounds is easy to get off, but then that last 5 pounds always takes like months and months, and you got to agonize for that last mile. And I think that's going to be where we're at on the inflation front, just because, again, a big part of this is labor shortage, and that stuff is still playing itself out in the marketplace, right? With the service sector trying to get folks back to work and dealing with the early retirements, and all of that stuff will be just a little bit more sticky of a problem. And I think that's, ultimately why the 2-year Treasury is started to go up recently, right? That it's starting to close the gap on where the Fed funds rate is. You normally don't see longer maturity lengths having lower rates than shorter, right? There's more risk, there's more opportunity for you to do other stuff with your money. And you can see that after this initial fear about the debt ceiling and these bank failures, where people got out of the stock market and into treasuries, and that helped to lower Treasury rates. The 2-year, at least, has started to go up. And I think that means that the 10-year is also going to start to go back up, meaning that there's going to be that upward pressure on mortgage rates, because you can't have a 3.86% 10-year Treasury forever in an environment with a 5.25% Fed funds rate. It also means we're at greater risk for recession, right? Econ nerds like to look at this thing called the yield curve, which is just the difference between the 2-year and the 10-year that I just showed you. The reason why they are so obsessed with this as a metric is that it's one that's pretty predictive, right? You can see that anytime we've had a 10-year that was way below the 2-year, it's been followed pretty quickly thereafter by a recession. It's like batting 1,000 when it comes to predicting a recession, at least over the last 40 or so years. And if you look at the right-hand side, we've been inverted. We've had a 10-year that was below the 2-year now for almost a year, and much more inverted than we've seen in a long time. And that means that people are skeptical about the short run of the economy, and that at least the financial markets expect things to grow. And I think it's, a symptom of both the ongoing inflation that we've had, but also just kind of where that macroeconomic risk lies, which is that I think consumers are starting to run out of gas when it comes to their ability to absorb the inflation. We talked about how wages were up a lot, almost 18% cumulatively from where they were before the downturn, right? But the price of everything that we buy out there is also up about 17%. Now, you would think that's pretty much a wash, right? Like everything I buy has gone up by 17% in terms of price, but my wage has also gone up by about 17, 18% cumulatively over that time. So we're good to go, right? But unfortunately, if you think about that through the lens of where the economy's come from, we also are spending more in real terms. This is inflation adjusted real consumer spending, and that's up almost 10%, right? So we canceled out the effect of inflation by seeing our wages go up, but then we also went out and bought a lot more stuff on top of that to boot, even after taking into account the wages. And so there's a gap there. And if you look at what that's meant for the economy, it's been a boon, right? Because 70% of the US economy is consumer spending. And you can see that's been pretty consistent over the last couple of years, but it looks the same whether you look back over the decades as well. We're a consumer-driven economy. And when you carve up GDP into its component parts, consumers dominate. But more importantly, over the last couple of years, if you look at how much of the growth, right, consumers are the biggest slice of the pie. That's what I'm showing you on the left-hand side of this chart, 7 out of every $10. But they've been 90% or so of all of the increase in GDP. So we're 90% of the growth, biggest slice of the pie, only slice of the pie practically that's been growing. And I just worry about the consumer's ability to continue to propel the economy forward because, again, our wages are up, but they haven't been up by enough to cancel out the price and all the other stuff that we bought, from cars to TVs and all of that stuff. And if you think about how we've, kind of bridged that gap between, our spending and the prices, we've done so by drawing down savings from double digits when we were getting free checks into our, bank accounts from the government, to now the very low single digits, but more importantly, racking up revolving debt, which is growing by 15% or so on a year-to-year basis. And there's a limit to how much you can put onto the credit card. There's a limit to how much you can run down your savings account. And I think that means we should expect consumer spending, which again is the only engine of growth at this point in time in the US economy, to take a step back. I think that explains why the yield curve is inverted, why the people don't want to buy treasuries, which is ultimately why we're seeing that, curve invert. And I think it's because folks expect consumers to run out of gas. We've had, about $150 billion increase in the amount of credit card debt out there. So yes, our wages are up by 17%, but we've spent a lot more and prices are up. And we've actually added about 18% to the overall credit card balances out there in the United States. We're getting close to $1 trillion worth of credit card debt floating around out there. And I think we're going to have to stop and catch our breath, meaning that even if we don't get into a recession, that engine of growth for the U.S. economy as a whole won't be as strong as it's been up to this point. On top of that, the financial markets have been a little bit wobbly, and real net worth on a per capita basis, this is kind of our measure of wealth, has been declining for the last 4 quarters consecutively. And I think that also puts strain on spending, right? Not only am I running out of savings and getting close to maxing out my credit card, but also now I'm poorer than I was this time last year. And you can see this is also one of those indicators that's pretty predictive of recession. When the U.S. household is on average getting poorer, the economy doesn't do well because we don't go out and spend money. And I think that also kind of backs up this short run risk. And you can see actually, if you look at the most recent data on spending, retail sales is declining, at least in real terms, which is what matters ultimately for GDP. So I think consumers are probably the biggest risk out there for the broader economy. But the other piece that I want to talk about is the commercial markets, because we've seen this kind of structural issue of housing supply and demand in California drive folks out of the state for many years. But that has really started to accelerate since remote work has become a thing. Last year, we had almost 500,000 people on net leave California. And for the first time in a lot of this pattern of outmigration, we finally started to see high income folks leaving the state finally. And that is concerning both from a broader economic standpoint, but also I think symptomatic of the challenges that the commercial market is going to face moving forward, because a lot of these folks are working remotely. Even though we're down from about 50% of folks working remote, it's coming in for a landing around 25% of the jobs. And some folks are staying full remote. Some jobs, they're bringing everybody back to the office 100% of the time, and then others are doing hybrid. But ultimately, if you kind of crunch the numbers and do all that, spreadsheet wrangling on that, it means, remote working in some capacity of about 25 to 30%, which means a couple of days a week. Ultimately, some folks working all the time at the office, some all the time at home, some going in for a couple of days a week here and there. And I think that kind of unlocks the potential for more out-migration or further acceleration, and also really affects demand for commercial space for things like offices. You can see it's mostly concentrated in our dense, urban, unaffordable core. We didn't have particularly egregious outmigration last year in Tulare County. It was only 3,100 or so folks compared to, 6 figures in LA County. And it, again, is mostly concentrated in those very expensive, unaffordable housing markets. But I think that's where a lot of the commercial strain is going to come in, because you have these companies that are going to be doing less well financially because of the consumer spending slowdown and just broader economic growth slowing. B, they're not going to have the same appetite for space, even if they do maintain their revenue and profitability, because a lot of their workers are working from home and they're rethinking how much space they need to occupy and what the layout's going to be. And all of that stuff. But then also they're dealing with higher interest rates, right? So there's going to be pressure on vacancy rates and rents, but there's also going to be a kind of cost basis to this as well. And you can see the vacancy numbers are already shooting up in downtown San Francisco. It's absolutely scary, right? We're at almost a 30% vacancy rate with some of these big marquee spaces going away. Again, this is mostly concentrated in those dense urban cores, but I do think has potential for contagion just to the rest of the broader economy. And, even in commercial space in Tulare, I don't think it's going to be as bad as it is on the Embarcadero in San Francisco, but we've got employers still grappling with remote work and this labor shortage. That means they're going to be loath to kind of rush everybody back to the office until they feel like they've got qualified people that they're able to keep in those jobs. You see the same thing in LA, where the headline vacancy rates are now approaching 20%, and there's been negative absorption for the last 3 quarters in a row. And I think that this is going to continue to play itself out as vacancies rise, rents decline. You're already starting to see it in terms of CMBS delinquency rates. So they're not collecting the rents and remitting them back on the commercial mortgages. Overall, the headline number is still pretty low. Hotel hasn't been terribly affected. Industrial and multifamily are actually almost non-existent in terms of CMBS delinquencies. But you can see that retail has crept up a tiny bit, but office in particular has seen CMBS delinquency almost double. And I think this again has the potential to spiral out into broader financial market issues, because that's kind of the trifecta when it comes to remote work affecting your desire for commercial space, the broader economy potentially shrinking or at least not growing as much as it has, meaning that your revenue, your top line income coming in the door won't be as good. And then on top of that, even if you want to keep your space, the cost basis for that space is going to go up, because we have about $1.4 trillion worth of commercial paper coming due over the course of the next couple of years. And even if you want to keep that building, you're going to have to go out and refi or find somebody to kind of re-up you on this debt. And then that's going to increase your costs right at a time when you don't know how much space you even need, and that your company isn't potentially performing as well financially as it has up to this point. And of course, a lot of this debt is held by the banking sector, right? Which we've already seen some turbulence there, and I think could spill over into more bank failures and potentially volatile stock markets as we move forward. So again, consumers are really going to need us. This actually makes real estate an attractive place to keep your money, right, over the short run. And I think that's another source of demand that we could potentially be drumming up amongst investors who just are looking for a safe haven, but why I think we should be bracing for a bumpy ride. And even though I think we've seen the worst for housing in terms of transactions, we're going to be grappling with just the broader economic environment as those buyers and sellers aren't doing as well financially moving forward. I don't want you to panic, though, because I don't think this is going to turn into 2008 all over again, no matter what happens with the broader economy. And that is for 2 or 3 primary reasons. One is that we have much different fundamentals than we had last time around. Even with the modest price declines that we've seen in the housing market recently, the percentage of homeowners with equity which I'm showing you on the bars here, or the dollar value of equity out there are both still near all-time high levels. You've got a lot of people sitting on a lot of cash tied up in their homes. And of course, you don't foreclose on a home that you have equity in. You simply sell that home. And this was not the case back in 2008, where we had a lot of loans originated with zero money down. You had a lot of 5-1 option arms that meant people had loans that reset because of negative amortization and went up even when they kept their job, their mortgage payment, they just couldn't afford anymore. A lot of no doc and like those ninja loan products, right? The no income, no job or asset type of stuff. This time around, we had almost too strict underwriting. I'm going to say not even almost, it was too strict. We didn't let enough people into the market. The average FICO score of folks that we were originating to was above 700 for like 10 years straight. And just because of how tight the market has been in California, it's meant that those very low down payment loans often couldn't compete in a market where a lot of people were paying cash. We were so inventory constrained, people were paying over ask price. They didn't have to worry about appraisals and all of that stuff. And although I think that constrained how much home ownership was allowed to benefit, right, from the run up. But also, I think, insulates us a bit by not creating all that systemic risk that was bubbling under the surface the way that it was, and that we kind of packed in during 2004, 5, and 6. The other thing is people are still current on these loans, partly as a result of having such tight underwriting standards and making sure that people could afford the homes that they've been in, and also just the strength of the labor market that I already showed you. Delinquency rates in California are actually the third lowest in the nation right now. Only 2.1% of our mortgages are delinquent, meaning that 98% of homeowners through the first quarter were still paying their mortgages on time. And so again, to me, this doesn't suggest a huge wave of foreclosures. If you go back to 2007-8, which was a year before the official recession even began, we were already threatening double-digit mortgage delinquencies because of all those loans recasting to higher payments and the 5-1 period not actually lasting 5-1 and having it reset much earlier, and people just walking away from those homes because they put no money down and couldn't afford those mortgage payments. This time around, you've got people in the lowest fixed rate loans of all time. The vast majority of homeowners have gone out and either bought or refied when rates were at 2 or 3%. And also they're still employed and making money, in some cases more money than they have in a very long time. And again, you just don't foreclose on a home where you're current on your mortgage and have equity in the bank. Even if you lose your job, you just sell that house and get out from under it, put some money in the bank, and wait for things to get better for you financially. The other reason why I don't think the bottom is going to fall out for prices is not only that we're not going to get that huge wave of foreclosures, but also because so many homeowners did go out and refi at the lowest rates of all time. I went and scrubbed the Freddie Mac data and looked at all 2.3 million or so mortgages that they make available in this big, giant, ugly spreadsheet on their website. But if you look at that, the loans that they've backed, 83% of those loans are at or below 4% mortgage rates. 99% of them are below 5% mortgage rates. And that has created an incredible lock-in effect that I think is going to prevent inventory from ever getting to the levels it had to get to start generating those precipitous price declines that we saw last time around. In fact, for anybody who goes to NAR, you'll know that at Lawrence's forecast that he presented back in April or May or whenever that was, he actually predicted that divorce rates are going to start going down, because even though you hate your spouse, you're going to love your mortgage and try and find a way to stay in that house. And I think it kind of, I don't know if that's, you got to have a strong stomach for that, but I do think it speaks to this lock-in effect that I think will be with us, not just during the current kind of business cycle, but until we get back down to rates that are in a place that people can stomach giving up their current mortgage and moving to a new home. And if you think about what that means for prices, right? If you go back to 2007-8, I think this is the biggest obstacle for home sales recovering, and why I don't want you to overly celebrate having survived the adjustment to these higher rates. but also going to be, I think, the main thing that prevents the bottom from falling out on prices and why you're seeing all those indicators I already showed you start to go back in the right direction. Back in 2007, we hit almost 17 months of housing inventory. That was because of distressed sales and just people trying to get ahead of the price declines and all of that stuff. Last month, it was 2.1 months of inventory. And when you think about inventory through the lens of that lock-in effect with so many homeowners stuck in these very low interest rate mortgages, I think it just really precludes seeing this kind of double digits, certainly not 17, 18 months of supply from happening, and why I don't think buyers are going to be doing themselves any favors by waiting for prices to go higher, because they're going to pay more and potentially face even higher rates. If you think about what those treasury yields that I showed you suggest about what's going to happen to 10-year and 30-year rates, that they could just be waiting and ultimately kind of ending up with a bigger self-inflicted wound. Because if you actually look at the MLS, we're not putting any homes onto the market, and it shows that that lock-in effect is true. We're putting less homes onto the market today than we were last year. Last year was the worst year ever for housing inventory, and you can see that new listings, this is how many have been added to the MLS every week, right up through last week, and they've already peaked and are coming back down. Same exact thing happening in Tulare County. We're probably past peak listings for the year, at least in terms of how many sellers are putting their homes onto the market. It's actually outpaced sales for the first time the last couple of months. But again, those new listings are petering out. So I don't think you should expect the total active number to continue to rise the way that it has been up to this point. And indeed, if you look at the local, this is the snapshot of how many are active, right? It's like 550 homes. It's kind of topping out and plateauing at this pretty depressed level. It's not as bad as it was back in 2021, but still way below those pre-pandemic numbers from 2020 that you can see on the left-hand side. And that was a pretty terrible year for listings in Tulare. So this, to me, it's not where we're going to find the buyers, it's where we're going to find the homes to put the buyers into. And that is A, the thing that's going to constrain transactions, but B, prevent the bottom from falling out on prices, and probably why those prospective home buyers who are drinking the Kool-Aid on what their brother-in-law told them might reconsider looking at the market and seeing if how many of these 545 homes might actually be desirable, and being focused more on the long term, that price appreciation. Show them that long run chart for the Tulare County price that I showed you, and I'll make sure that Janet and Wendy and everybody have these slides so that you can take them and use them. But I think that is helpful context for folks who may be, again, waiting for nothing, waiting for a bottom that already happened back in November on kind of bad advice. But when you look at the competitiveness data, it suggests that it's becoming harder for buyers, not easier, right? Statewide, last week, we were at 16 days as a median time on market, down from 42 back in January, early February. Same exact story for Tulare, right? Down from 42 days back in February to just 15 days last week. Homes are selling faster, not slower. We actually have fewer homes that have done a price reduction statewide. It was about half back in November. Last week, it was less than a third. Same exact story in Tulare County. I brought the local data because I wanted you to know this is happening in our own neck of the woods, but these are macro-driven trends, and you can see the same stuff playing out in our local markets. Statewide, over half of the closed sales last week closed above list price, up from less than 20%. At the turn of the year, we had even more than that close above list last week in the local market, down from almost 10%, right? So they've quintupled from where they were at the beginning. So again, the market is getting more competitive. Prices are going up. Sales are going up. Prices are going above list more often. And I think these are all stories that we can, use to combat the story that the housing market is falling apart, but B, to kind of get some of those qualified buyers back off the sidelines, have these conversations with investors that show those long run price appreciation trends are undiminished. And yes, if you look at our forecast, we have prices down this year. but only by 5.6%. We have them going back up to 780,000. That's an annual average. And I think we've probably seen the biggest declines on a year-to-year basis already in the rear view mirror. I don't expect them to go rocketing back to the all-time high levels, but I do think that the bulk of the decline is behind it. Same thing with transactions. If you look at our forecast, it's for sales to be down 18% this year, but to a pace annually of 280,000 units. We've already fallen to 235 and climbed back to 280,000. And at least for the next couple of months, based on what I showed you with those weekly pending and transaction data that goes through last weekend, we should maintain that at least through the first half of the year. They might come down as things cool off in the winter, as they always do. But again, I think the worst is behind us for transactions, at least, and sales have actually been going up, not down, for 4 out of the last 5 months. And actually, don't get me in trouble at work, and please still come to the forecast in Anaheim in September, of which I think tickets just went on sale, shameless plug. But our forecast for next year is that sales will be even better. We don't have them going back up to those 15-year highs that we hit in 21, but we have 340,000 units, which means 60,000 extra transactions or 120,000 extra sides. And again, I think the worst is behind us. You just don't want to throw it in autopilot and congratulate yourself for having survived. But I do think there's a lot of good data here that you can use to embrace that role as a trusted advisor, talk those sellers down from the ledge, get buyers who are qualified back into the game, and focus not on the next 12 months, but on the next 12 years. Because I have no doubt that we'll be kicking ourselves and wondering why we didn't buy up as many of the homes in Tulare as we could when prices were still $350 or $380. Because I'm sure they're going to be a lot higher if history is any indication of that. So I know I talked for a long time, but I really appreciate the opportunity to be with you. Hopefully that data is helpful on showing you that the worst is behind us for housing, and that even though we may have a bumpy economic road ahead of us, it's not 2008 all over again. And I'm actually becoming more optimistic about housing, not less. Thanks.